Okay, all right. Hello, everybody, and welcome to this week's edition of Selfwealth Live, the technical analysis edition. We're here this week again, once again, with my right-hand man, Jason. Maybe I'm his right-hand man. I'm not sure, but Jason from Motion Trader. Thanks for coming along today, and I'm Roger from Selfwealth. Obviously, this show is brought to you by Selfwealth, but Jason is from Motion Trader, which is a great service that he runs as well. Right, so. Jace, how are you this week?
Hey, Rog, I am well. Looking forward to talking about some stocks, about the markets. All pretty good.
Of course, that's what we're here to talk about. Welcome, everyone on the other side of the chat. This week, I know last week I had to cut it short, but this week we'll have a regular program. So it does go over around about, an hour to an hour and 20 minutes every week. So I'm glad that everyone is loving this sort of longer format or likes this longer format. And even if you can't make it, you can always watch a replay, which is great. But yeah, there is a lot to talk about once again, even though the markets are still, I don't know, I feel like they're waiting on a special man to make another announcement, right? So that's my opinion anyway, and I think it's a lot of what other clients are saying as well, right? So it should be interesting. There's a few questions already, a few tickers that have come in via email throughout the week, so some opportunities for us to scan, or maybe not opportunities, right? So we'll see how we go there. But before we get going, let's have a look at that disclaimer, Jace.
Yes, so everything today, general commentary only, no personal advice. And I'll quickly pop up our disclaimer that we put up each week, and that just goes through that. Also, I'm not part of Selfwealth, as Rog mentioned earlier. My details are at the top with licensing and all in there, and beneath there is Selfwealth's note with licensing, general commentary. All of that important stuff is in that screen on there now.
Fantastic. Thanks, Jace. And obviously, you can just scroll in the description on this YouTube live if you're really interested in reading that whole thing. There's a video there as well. Obviously, every week we do this similar format, Robert. Just if you are a new person, what we do is we scan the three major markets that we offer at Selfwealth, which is the ASX, the US markets, and obviously the Hong Kong markets. If you do want to have a look at one of the other international indices, then feel free to pop it in the question and we can have a look as well, right? That's fine. Then if there's some general questions, which there are a couple of general questions which I missed last week. So I'm going to revisit a couple of these questions. And then after that, let's have a look at some tickers of yours, obviously the companies that you're interested in, and have a look at it from a technical analysis perspective. So once again, we don't look at the fundamentals or the company reports. We look at what a company looks like on the chart and the pricing charts and how it's displayed technically, and how we feel about it technically, right? So, all right, let's get going with that Aussie market then, Jace. What's it doing this week?
Okay, so let's jump over to these charts. So starting with the ASX 200, and so a strong rally for the ASX 200 last week. Prices getting back to above where they were prior to that sharp sell-off during late March, early April. And the rally is now back to the 100-day moving average. So this blue line is the 100-day moving average, and then we've got the 50-day, which is below that. And prices were extremely stretched about 3 weeks ago when we had that sharp decline. They really pulled away from the averages. And as we've discussed previously, when prices get stretched, could be stretched to the upside or the downside. But when they do get stretched, just like when you pull back on a rubber band, they often snap back, and that's what we have here. So I think the question is, what happens now? Well, I think the underlying structure it's certainly improved, but there's always that level of vulnerability to it until prices can clearly get back above the moving averages, and then the 50-day moving average can get back above the 100-day moving average. So that hasn't happened as yet. And while that remains the case, I think we do need to approach the market with a little bit more caution. Now, when I say caution, I don't mean be bearish. I think we should keep an open mind that this really was a panic-driven sell-off, and that the worst is over. I think that's entirely possible, and there are some positive factors lining up to support that. But I think while while that's certainly the possibility, I think we do just need to have that caution until the moving averages do sort themselves out. And when prices, and this is the thing, when prices are above rising moving averages, there's a tendency to buy the dips. We saw that all through last year. But then when prices on the wrong side of the moving averages or below the moving averages, there's just that greater risk that the rallies get sold. We saw it get sold in March. So far, it's holding up really well. But we do want to see that flip to the correct side of the averages. And I think with the ASX 200 right on its 100-day moving average at the moment, I think this is shaping up as a critical period. I think that a positive here is that the ASX 200 has done a really good job at holding onto these gains off the lows, and we saw that with the recent consolidation about a week and a half ago, where prices had rallied and then they just held steadily for a few days before rallying again. And I think that's always a good sign, because it suggests that buyers are accumulating in the pullbacks and it's not a rush to sell into the rallies. The ASX 200, it's just below a resistance region around 8,100. You can see this blue shaded area across here. So it takes in some previous highs from last year and takes in some lows again from last year. So I think that's an area to watch. The next step, I think, for a recovery is to break back above this area. So then that would be clearing the moving averages, clearing some resistance, and that really does start to put the ASX 200 on a stronger footing. And we could see that happen in the near term. Prices just pausing beneath there at the moment. I think the odds are increasing that this sell-off was panic-driven, was a panic-driven event, and not a larger bearish turn. I'm still holding stocks in my portfolio that I've held for some time that didn't trigger trailing stops during the sell-off, and I'm happy to do that. That's why I use wide trailing stops to try and see off volatility when it does occur. And I'm also selectively buying some stocks that are triggering buy signals. That said, I'm also holding extra cash. So it's really a case for me of gradually rebuilding as we're getting more positive signs from the market. But as I said, I'm still playing this cautiously. It's not a case of, okay, right, all in, let's go, because there's always risk, and particularly when we're below moving averages. So I'm taking it cautiously, but I'm moving back in that direction of buying stocks.
Yeah, I think that's a good way to look at things for sure. And I'm very similar position there. Definitely a little bit more cash in the portfolio, but at the same time, I've kept, like 6 or 7 of my winning stocks that are they're still there, and they're still slowly climbing. A bit of a dip with this recent dip, but they're starting to climb up again. But obviously be cautious around that and remain cautious. All right, let's have a look at the US markets.
Okay, so S&P 500. Well, this is getting really interesting. Is this the basing period that we've been waiting for? I think the potential of that is certainly there. I think the next few days could tell us quite a lot. I think we're at a critical stage within this period of over the last 3 or so weeks. And I think the best part is that we've got a clear levels to base our decisions. So on the upside, I'm just watching this resistance around 5,500. You can see this blue shaded area takes in a couple of lows from March, also takes in a high from mid-April. Just starting to nudge through there at the moment, but I wouldn't call that a decisive move through there just yet. And just above that 5,500 is the 50-day moving average. So a couple of key areas to keep an eye on. I think that a clear break above this region at 5,500 would open upside potential and I think really increase the odds that this panic or that this sell-off was indeed as we said with the ASX 200, a panic-driven event and not the start of a larger bearish phase. Now, I want to show you an indicator which I've been watching, and this shows the percentage of S&P 500 stocks above their 100-day moving average. And the way this works, let me just compress this. You can see it oscillates between the top and the bottom. So when the percentage is high, so the majority of stocks or almost nearly all stocks are above their 100-day moving average, that's where markets tend to form tops. And then the opposite applies when it's washed out and there's nearly no stocks above their 100-day moving average. That's where you tend to find bottoms. Now, what's been interesting in the last couple of weeks is that this indicator's moved to a secondary high. So let me just take you through what's happened. It's sold off. It's gotten, see this blue line, that's 10%. So it got below 10%, rebounded above 10%, got up to about 28, started to pull back, and now it's broken up and now it's made a secondary high. It's up around 30% of stocks above their 100-day moving average. So for me, this is a sign that there's internal strength, that the internal strength of the market is improving. And the fact that a growing number of stocks are above their 100-day moving average, I think is positive. And when this happens, there's a tendency for momentum to continue to build. And I think I think last week's move above the April high, so you can see April's high in the indicator, pulled back and then made that secondary high I was talking about. When we look back at similar situations, the secondary high is typically a confirmation of a shift in momentum. So I'll show you what I mean. So just come back. It's different. It's not the same every time. It does vary, but you will see this pattern. So look at these two examples from 2022. Below 10%, above, pullback, secondary high, and then that was it wasn't the final low, but it was the start of a multi-week rally. Then in September 22, down to 10%, rally, pullback, secondary high, again, start of a significant move higher. And we can go back. You can go through on your own and just closely look at this, but just quickly, a couple of examples. 2015, 10%, initial rally, pullback, secondary high, multi-week rally in the market. This was a final low, down to 10%, rally, pullback, secondary high. That was a final low on the market. And we can keep doing this if we scroll back, but let's not do that now. It takes a bit of time to do it. There's never any guarantee with these things that that's exactly how it's going to work. This period is going to have its own unique price action. There's nothing to say it can't come down and retest 10% and have another washout. You just don't know. But I think the odds start to shift in the favour of a panic low is in place and that there's momentum returning to the market. So just coming back to the S&P 500 quickly, if the market can clear this 5,500 region, should we go all in? And I think the answer to that is probably not. I think we should be conservative in any action that we take just while we have this situation below the moving averages. I'm maintaining a defensive footing while prices are below these declining averages. So one scenario could be maybe the market does lift for a couple of weeks, and then it could just the rally could lose momentum, and maybe during late May or into June there's a secondary fall. So I'm not saying that, I'm suggesting that will happen, but just to say all sorts of things can play out. There's no sure things. And there's still a high degree of uncertainty. But I'm prepared to I'm starting to move back towards the bullish side. I bought some S&P 500 ETF on Thursday on the ASX, so it was around this point here, where the cursor is. So that's moved up a little bit in the last few days. So just playing that potential for a turnaround. I think averaging into ETFs this is something I've been talking about in my Friday strategy sessions. Averaging into ETFs longer term at these lower levels, I think is a play to consider, even at current levels. But just never underestimate. There is still risk, and I think this remains a market below declining moving averages. So approach with caution, but I don't think it's a time to be completely scared out of the market altogether. I think we want to look at this, look at the positives, and run with them, but be ready to control risk should things take another downward turn.
Yeah, good analysis. Would you say you'd be a lot more confident when obviously the price has to be above the EMAs, but also looking at that other, higher sort of higher low point there? That you'd think that the price would be over the EMAs and over that higher low, most recent higher low. You'd be a lot more confident then.
Yeah, absolutely. It's like when a market is looking at how this period through here in 22, the market was rallying strongly. Like we just cut out the rest of the price action. The market was at a final low. Look where you can see I'm pointing at the moment. Was at a final low. Got a strong rally back up to underneath the 50-day moving average. We could have looked at this at the time and said, look, there's signs maybe there's a turnaround taking place. There's some overhead resistance, but we're still below the moving averages. Proceed with caution because we aren't on the right side of it yet. And as it turned out, there were further lows to come. It's not like we've been rallying for a period of months. We've just pulled back to the rising moving averages. I think that's where we approach it with more confidence. Let's buy a dip back towards rising moving averages because I think the odds favour that the rally continues. But we're trying to pick a turning point in a market where the trend is still technically lower. So we're preempting a turn to an extent. So for that reason, I'd prefer to see, and this is also difficult with V-shaped recoveries as well because they also happen so quickly. Sometimes we get a period where the base building is a bit slower, and then prices make their way above their averages, and they waft around for a few months, and then they really start to get some momentum. But when you're dealing with these V-shapes, it happens faster, but we always remember we're still in the bears half of the playing field when we're below the moving averages. So that's why there's I think a bit of caution to the approach.
Okay. All right. Let's have a look at the Hong Kong market then.
It's a tricky one. There's momentum starting to return to this one, but it was such an abrupt decline. It's made a bit of a mess of the chart. Previously, we had this stepping pattern where the market would rally, consolidate, rally. Some of the consolidations were long, but they looked corrective, and then you get the strong advances. Now this isn't a corrective looking pullback. It's just it was like a panic sell off. For me, it's hard to get excited about this market at the moment. Prices have moved higher through the week. But again, just coming back to that moving average structure, it hasn't really flipped around yet. It's close to getting back above the averages, but then might need some time to stabilise before just give us something clearer to work with. I just think it's a bit messy, so I'm not in a hurry to do a whole lot here. Going over to China, this is a little different. Maybe there's something building here. We've got this spike low and that V-shape recovery. Prices are now back above the moving averages. That said, the moving averages are pretty flat and just going sideways at the moment. I think there's a bit more work to be done here before we could say prices are breaking higher. But this is probably one to watch. If prices can stabilise above the moving averages and then start to push higher, well, then maybe that could be the makings of an opportunity. But I think we can probably just watch for now.
Yeah. All right. Not much to do there in the Asian markets at this point. Let's get on to some general questions that I missed from last week quickly. I had one here from Michael Jason. How do you balance long-term versus short-term positions? Do you apply the same rules to your long-term portfolio?
Probably apply the same principles rather than the same rules. And also, I'm not really doing much short term. So my focus would probably be medium term for my actively managed portfolio. So that's where I'm looking at individual stocks. I'm looking for breakouts, looking at the moving averages, calculating trailing stops. That's what I do in Motion Trader. It's a medium-term focus. So say 1 to 3 years is where I get my biggest gains. But that said, it's active in the sense that if something's not working out after a week or two, it might hit an exit. So it can be active, but can also hold over medium term. Longer term, that's a sort of thing like where I might buy. Like an example is where I bought a uranium ETF a while ago, or it could be like an ASX 200 or an S&P 500 ETF, which I might hold longer term. Could be a super fund type hold. So for that, I'd use the principles that I'm looking for broad strength and markets above, say, 200-day moving averages. But I might not be too active in the selling as well. Like, longer term into index, I think you can be quite passive with holding an index. I wouldn't suggest doing the same with a stock because stocks are situations can change with individual stocks. I'll show you an example of how I managed a longer term position in uranium. So this is a US listed ETF, and so when was it? It was in December 2020. So I bought a position in this ETF and it was intended as a longer term position. I bought a position somewhere around here in December 2020. So I'm applying the same principles that I'd often use. It was a market where there was broad strength, above moving averages, and then it was just a case of like holding and seeing how it went. There wasn't a calculated trailing stop on this because it was sort of intended as a longer term hold, which meant I sat through this period of consolidation, which went on for a couple of years. Longer term, you've got to be able to sit through those longer periods. But I was always looking at the price action. It came close to thinking like, should I be selling this as we had price action below declining moving averages? But just taking the entirety of the picture in, it did look like it was a corrective move. So I held on and got the upside. But then I actually sold it around February when the price structure really did appear to be breaking down, and I couldn't justify holding it even longer term because who knows where things can go longer term. You never know. You can't be sure. A stock index, maybe I would have held longer term, but a sector ETF, I didn't want to just close my eyes and hold longer term. So I guess my approach will vary. I'm using those same broad principles, but not probably the specific rules which I use for individual stocks over the medium term.
Okay, thanks for that. The next question from last week was from Kirby. Do you consider volume action at all when prioritizing buy signals?
Not really. I may have a look at volume, and if there's a strong volume day and a breakout, it supports the price action. But sometimes I see you can have breakouts and the volume's relatively low, but it turns out to still be a great breakout. And sometimes you get a high volume breakout, which then reverses. So you look at the textbooks and they make a good case for volume being a great supporting factor. But in my experience, in the local market, at any rate, I haven't found it to work as well as it does when I look at some of the textbooks, which are usually focused on US stocks. So whether there's a difference in how volume plays out in some markets, I don't know. But for me, I work on the price action, not as much the volume.
Okay. All right. Fantastic. Let's get on to some stocks. We've got a couple here from the US, 3 from the US and 1 from Hong Kong that came in through the week. So let's start off with Meli, please. Meli. MELI. Thanks for all your stocks, everyone. We will get to them as much as we can. We will get to them. I like the feedback there, Jules. I'll definitely pass it on. Trailing stop just for our show. That'd be good. Wide trailing stop.
Yep, that's and wide trailing stop would keep someone in this stock here. So this has had, I would have said this has been like an entry point would have been January 23. So from below the moving averages to above, we had a consolidation, and then we had a breakout a few months later. And following that breakout, a wide trailing stop would have stayed in this entire move. It remains an upward trend. It's yes, there's been volatility. It's handled the recent volatility quite well. I'd suggest if I had this one, I'd continue holding it. It probably doesn't stand out as a stock I'd have to buy now. It's certainly could. I like the way it's recovered. Like it's a V-shaped recovery, and it's gone to almost at a new high. So, I guess if somebody like this, they could consider buying a stock like this at current levels with a wide initial stop, because it could do some more consolidation above the averages. But overall, yeah, trends up. I'd be happy holding it.
All right. Next one is PLTR.
And same applies here. I'd be happy holding this one. Wide trailing stop probably could have seen off this spike, because it had been such a volatile stock. I think a wide trailing stop would have been wide enough. Let's have a look. I just put on. This isn't the Motion Trader wide trailing stop, but it's gives us an idea. It's a 10 ATR stop. So yeah, there we go. It would have just, so a 10 ATR stop could have just seen off this volatility, and this is the beauty of the ATR stop, because ATR stands for average true range, or average trading range, and it's a multiple of the average trading range. So if the trading ranges are wide, that multiple is going to be wider. If the trading ranges are quite narrow, well, then the stock will be closer to the current price action. And due to the volatility of the stock, the trailing stop has really been held right back, giving it a lot of room to move around. And it's not like a magic level, but in this case, it's worked. It's gone in favour of staying in. It hasn't hit the stop, and the stock is now almost back up to its previous highs. So yeah, I'd be holding this one if I'd had it for a while, and I'd continue using my wide trailing stop to stay on board.
I might ask a question based on that, actually, Jason, because with the wide trailing stop there, it was showing that, if you were to get out of that point, you were 50% down from that high, basically, right? So it was 120, and then you're sitting at 60, right? Almost 50%.
Yep.
Would you still be sitting through that?
Yeah, 100%. And I've sat through exactly that type of pullback, and this is the beauty of the wide calculated trailing stop, because it's calculated, so it means you can back test it over a lot of time, and you can pull up examples exactly like this, and that builds your confidence to know, hey, it's wide, and this is exactly why it's wide. So a lot of people say, look, I want to set my trailing stops closer. I'm more comfortable with 20% or 15%. But the challenge with that is that stocks are volatile, and if you it's all great to get this upside volatility, but upside volatility generally comes coupled with downside volatility. So it's very difficult to trade a stock which is going to have a lot of movement if you want to have a close stop. We might like it, but what we like isn't necessarily what works well. What works well is when you give stocks a lot of room to be volatile, but you do have a cutoff point. You have a line in the sand where you say, okay, hey, that's enough. I'm now out. But a calculated trailing stop for me beats a discretionary stop, or beats a close percentage stop, for the very reason that it's tailored to the particular stock's situation.
Okay.
And in this case, it's a volatile stock, so it needs that room to move. Doesn't mean it's always going to work and keep you in, or you're going to give back profits. That's the price of admission to the stock market and staying on big trends. You've got to give back profit Otherwise, there's like you can, if you want to try picking tops in markets, it's like it just, you end up leaving so much money on the table. Like we look at a stock like this where like say you bought it. Like I'm just looking where an entry trigger would have been. So here's an entry trigger back here in May 23 at $11, and you go back and like where do you want to? Where do you say, okay, I'm going to pick a top and get out? Like there's a scary pullback, but it's well within a wide trailing stop. Then the market rallies again, and like we're up 100% when someone getting nervous and want to sell. And the point is you can stay on these stocks with that wide stop and take it from $11 to $120. So we're talking about a tenfold win in this stock. But I don't think you're going to do it with a 15 or a 20% trailing stop. It's going to buck you off. But if you can hold your nerve and use a wide stop, this is what's possible. And this is where we can make a lot of money in stocks. Not every stock needs to do this, but if you can get maybe 10% of your portfolio, which really runs a long way, we're talking 100% plus, that's how you get an outperforming portfolio. But the most critical thing from my perspective is you've got to give them room to move with that wide stop. And this is where I think so many people just, it's one of the pieces they're missing in their stock strategy. They try to hold on to their profits too tightly, and they get knocked out, and the bus drives off without them.
Yeah, good point. All right, looks like Earl is having a good time on the top of Mount Wellington in Tassie, clear as crystal. We are coming across here, Jace. So good on him. Some of us seem to be having the life at the moment. All right, next stock here is Meta, Facebook platform, is it?
And also, just on you saying, look, can you sit through a 50% pullback? If you own one stock and all your money's in that one stock, you're not going to be able. You'll be mentally fried. But if you've got 20 stocks in your portfolio, and say 1/20th, or maybe it's the positions run a bit, so it's a bit larger weighting in the portfolio, but still it's 1 out of 20 stocks. Can you give 1 out of 20 stocks a bit more room to move around? It's like it's not as nerve-wracking when you have many relatively small trades rather than one or two mega trades. That's when you really feel a 50% pullback. But if one stock pulls back 50% and rallies again, you can. I know I can live with it. I know it's a lot easier for others to live with when everything's not riding on one stock.
Yeah, it's a good point.
So spread risk, and look at the portfolio's overall value rather than fretting about one individual stock. Look at the overall movement of a portfolio of stocks. And some of them have wider stops. It's for a reason. It's because they've got more volatility, hopefully on the upside as well. That's why it's calculating such a wide stop, because it is moving to the upside. So you've got to give it room to pull back and then hopefully go again.
Very good point there.
Meta. Well, it's on the wrong side of the averages. So it has. Let's do the trailing stop. Let's see whether that would have triggered. So this stop would have triggered. So say the initial entry would have been like the moving averages have crossed. Initial entries back down here around 201, and it would have triggered an exit up here at 560 towards the end of March. So if I was in this one, I'd now be out of it. It's triggered a trailing stops on the wrong side of the moving averages. I don't want to be in at this point here. Now, could this be the lows, and could it rally again? It certainly could. But for me to be interested in this stock, I want to see it back above the moving averages, and the averages starting to turn higher. There's nothing to say that this situation can't get worse. There's nothing to say it can't continue to make its way lower. That's always a risk when a stock is below declining moving averages. It brings in a layer of vulnerability, and I don't want to be playing when that vulnerability is is present. So I'd be leaving Meta alone at the moment. If I was holding it and I hadn't sold during this period, maybe I could use the recent lows as my level of last resort. So I could say, look, okay, I'll give this the benefit of the doubt. There's some positive signs in the market. Maybe this whole thing is going to turn around. So if Meta breaks below its low from 21st of April, I'll just say, look, enough's enough. I'll sell it then. Maybe I think that's probably the way I'd play it if I held it at this point. But I'd probably want to keep it on a tight rein. I don't want this to potentially get out of control. And don't say a stock like Meta can't continue to fall. Like this had a dreadful time during 2022. So strong stocks can become weak stocks, and that weakness can persist. And market leadership can change. The market may rally again, and there could be other drivers of higher levels. We don't know. We can't see that future. So I'd be careful with this one. I'd know where my exit point is, and in terms of buying, I'd wait. I'd wait for more positive price action.
Okay. Going on to a Hong Kong stock, 1571. XIN Point Holdings. That's the one.
Oh, that must be, yes, that's the one. Yeah, no, not below the moving averages. It looked to be all coming together, but it's like the Hong Kong market generally. That sharp decline really has played havoc with it. I'd leave this one alone for now. If I had it, if I had it, I probably would have sold it earlier as it was really starting to break down. Again, we could use the low from late April as if someone was in it and they're stuck in it, going, what will I do now? I guess one strategy would be, see if we get a rebound back towards the averages, and then see if that rebound can gain some momentum. If it can't, if it breaks below the recent low, enough's enough. I'd just say, okay, time to protect capital. I'll just move this one on.
Yeah. All right. Quite clear there. Let's get on to back on the ASX. We're on MAU now, please. MAU.
Yeah. No, this is a gold stock. It's building nicely. It's gone from below the averages to above. It's rallied. It's pulled back to the averages. It's rallied again. If I had this, I'd be very much happy holding it. Could consider buying it at the moment. It's like the gold price has some corrective activity going on in that, but this is more of my understanding, more of an exploration play. So if that starts to come together, maybe there can be upside regardless of what the gold price does. So I guess it could be bought at current levels with a stop below the 100-day moving average and below the recent low, or maybe buying a breakout above the March high. But yeah, very happy holding it if I've got it.
Okay, next one is PRN.
Yeah, well, this has gone. This would be a hold for me at this point. It's had that volatile period. Like it had been trading nicely above the averages. It's had a couple of sell-offs. I believe this sharp move down in February might have been due to a corporate action rather than a company specific news. I think there was some sort of a share consolidation. And this, I'm not sure whether this price data has been adjusted to reflect that. So I think this would be a hold. It's I like that it's how it's seen off the volatility quite well. There was a bit of panic, but then that's quickly subsided. It's been bought back. It could be if it starts. Like I'm wondering whether this is a buy. Maybe if it consolidates above the moving averages and then breaks above the high from maybe this week, it could be a buy. But it's certainly, I think for me, it's certainly a hold at this point.
Next one's Wes Farmers.
Yeah, same. It's like wide trailing stop could have seen all this volatility off, and this period has been a great advertisement really for wide trailing stops. Why we use them, take the panic out. So many people would have been selling on that spike lower we had a couple of weeks ago, and something justifiably did need to be sold. But if you've got that rules based process to guide your selling, it does help you avoid some of the worst of the panic. It can get you out before the panic sets in, or it can see the panic off altogether. This is a stock I'd be continuing to be happy to hold. The broad trend's still up. It's just whether there's more consolidation that's possible. But yeah, the trend here is up. Happy holding it. And I
Okay.
like that it's relatively strong. Look, it's almost up at its highs, whereas the ASX 200 still has quite a bit further to go. So it's a stock showing relative strength.
Hard to go past Wesfarmers when it owns so many big retail companies here in Australia. Sometimes when you think about it, ART.
Yeah, so I had this stock and I sold this stock. Where did I sell it? I think I sold it. I think I sold it before it spiked lower. Um, so that's what I've done. I think it was a time exit for me. I'd been in it. It ran up, then it started to come down back below the moving averages. It's probably like I think it would have been a stop loss exit, trailing stop exit as well, because it came back so much. So I'm out of this. I think out of this one is probably the play for the moment. It's rallied back to the moving averages, but whether it's going to re-establish what was going on before, I don't know. It remains on the wrong side of the moving averages, so I'd probably be more comfortable just steering clear of this stock at the moment. And yeah, if it gets back above the averages, I can look at it again. But for now, it's not strong structurally for me to want to be getting involved again.
Okay, next one's ABB.
Yeah, this is looks. I think it looks constructive. I like how it's seen off the volatility. It's very much in a trading range at the moment. Like you can see it. Like it's not correct lines. What I'm doing, and just drawing something in just to really sort of like show roughly where the range is. But you can see it's trading within this ranging type of zone. Yeah, a break above the March high is probably like saying this stock's getting some momentum to the upside, so it could be a buy, and it's around $4.12 at the moment. Let's see. Yeah, maybe another 8 cents higher. It probably stacks up as a buy. I'd be certainly happy holding it if I had it, and I'd consider buying it if it got a bit higher and just breaks out of this area of congestion. That could be a sign there's another round of momentum coming.
Okay. All right. Next one is AIM.
It's for me. This would still be a hold. Had this great momentum. I think it's done a good job of holding together during that volatility we've had. But what's interesting with the market snapping back so well, this hasn't snapped back. So that's a bit of a concern. And we've got this sideways trading, which is probably more towards the being below the moving averages and being above. So the concern for me here is that it breaks lower. So you can see the range. There's the range, and while the market snapped back, this hasn't. So I'd say we're probably consolidating more or less below moving averages. Yeah, I'd want to know where my exit is with this one. I'd check my calculations, know where my selling point is. If it starts to break this series of lows, well, then maybe this stock is breaking down. There's increasing risk.
Okay.
Yeah, I think there's a vulnerability here. I certainly don't want to buy it. If I had it, I'd continue holding it for now, but I'd want to be clear what my exit strategy is in the event that it does break down. If it doesn't break down and it rallies, great. But yeah, know where my exit is for this one.
All right. EIQ.
Breaking to a new high for the last few years. I'd certainly be holding this one. Well, actually, it made a new high earlier in the day and has pulled back a little bit. So yeah, I'd be happy holding it. I think in terms of buying it, if it can break above today's high, if it breaks today's high, I'd say okay, that's one I'd consider buying. At the moment, with it just pulling back, I'd for the sake of a couple of cents, I'd say okay, let's just see what happens. Let's see whether it just pauses, maybe it consolidates for a couple of days and then breaks higher. Maybe the break high doesn't come and it just starts to drift off, in which case you don't need to get involved. But I think a new high, I think, would be a trigger for an entry into this stock. Stop loss back below the 100-day moving average. See where it goes.
All right, fantastic. Good one. BC8.
A gold stock. Now, gold is at an interesting phase at the moment because it's really started to get that parabolic shape to it. In that it's had such a strong rise in the last few weeks. So I'm cautious with entering gold stocks. I'm happy to hold gold stocks. I've got gold stocks. I'm happy holding them, but I'm just probably wary about buying them at this elevated point. I'd be very happy holding BC8 if I had it. The trend is well and truly in place. Rising moving averages. Price isn't overly stretched above the moving averages or overly stretched above the 50-day average. Has had a big run. It's up. It's gone from 25 cents to over $1. So we've got a threefold rally there. But yeah, look, I'd be letting this one run. I'd just be careful buying gold stocks after a big run. I like to buy gold stocks when gold is rallying off its moving averages, not after it's just shot away from its moving averages and is maybe getting ready for a correction.
Okay, while we're on the gold, do you want to have a look at the gold chart? Have a quick look at it.
Yeah, okay. And here it is here. So you can just see this latest part. It's almost vertical. When a market goes up vertically, it can be getting close to a longer consolidation. So we can see other examples of vertical liftoff in gold, which then came to an end and there was a larger consolidation. Here's another vertical liftoff, and again comes back and consolidates. So will the same thing happen again? Well, it might not. It might not even be a long consolidation. Like here's a vertical point here, but then this is only like maybe a 2-month pullback to the moving averages, and then it was off and away again. So I'm happy holding gold stocks. And there's nothing wrong with this pullback at the moment. I like that it's holding onto its gains. That's positive. It might be getting ready for another launch higher, but I'd be more inclined to want to hold my gold stocks and then do a whole lot of buying of gold stocks. There's been lots of opportunity to buy gold stocks over the last 12 months. If someone hasn't been buying gold over the last really year and a half, and all of a sudden has read a news report that gold's been doing well, and thinks, I might buy some gold today, I don't know that this is the time to abort. I think the time to abort were these lower price points. Now's the time for holding what you have rather than getting interested in probably establishing your first position.
Yeah, and does silver look the same, or
silver looks quite different? Gold's been acting as a bit of a safe haven buy. So this whole story around does like a whole lot of central bank buying. So it's like, are central banks less inclined to hold US treasuries? and instead are they buying gold? That's sort of one of the lines of theory around this. So it's the buying of gold, which is happening as a safe haven, as a store of wealth. Silver kind of tacks onto that a little bit, but not as much. Just behaving more like an industrial metal than a precious metal at the moment. It looks more like copper. At the moment, it's very much in a range. You can see the range clearly here. I don't think there's anything to do with silver while it's in the range. If it were to break out of the range, let's just compress this a little bit more. Like, is it like another period like we had back in 2023? If it breaks to the top side, sure, go with it. But if you're looking at it as a way to play catch up on gold, I think I'd rather just be involved with gold at this point. Silver doesn't look like a standout at this point. But let's judge the price action according to what it does. At the moment, it's not saying we need to do anything. If it breaks out, well, let's look at it then.
Okay. All right, back to stocks. We're looking at DYL, please.
So uranium play. Strong rally off the lows, getting back through the moving averages. Is this a low for uranium stocks? Needs to do a bit more for me. It is a strong rally that we're seeing in some of the stocks, and then you look at the uranium price. But when you look at the uranium price, hasn't been as strong at the moment. That's just rallied back to just slightly above the 50-day moving average. So the uranium price remains in a downtrend. So this is the tricky part with going ahead and buying a uranium stock, because it's had a quick rally when the underlying product remains in a downtrend. Now, this could be a low and it could be forming a base that could turn higher, but it's too early to say that. This just could be another rally back to the moving averages, which then lets loose to the downside. We're seeing, just looking at some of the other ones, so there's Boss Energy. We've got that same sort of price action, and Bannerman, again, similar. DPLO is probably could be the strongest of them, of those three. Look, if I had some, I'd be happy holding it. Could have a stop below the low from the 23rd of April. See where this goes. Maybe it goes somewhere. I wouldn't be a buyer at the moment, but look, at some point this whole uranium space probably will turn around. Whether it be now or later, I don't know. It's early. I think it's a little bit too early to say it's turned, but yeah, look, it's certainly a rally of note to keep an eye on.
All right, next one is from Phil. NST, please.
I'd probably wait for the next pullback. So say we get it's going to consolidate at some point, and if we get a consolidation that holds on to most of the gains, that's when I start getting interested, and then buy the breakout from that consolidation. Maybe that's the play, rather than just see a 3-day rally and say, hey, it's taking off. What's the next pullback look like? Does it hold on to its gains, or does it give them back quickly? That'll tell us a lot. Sorry, Rods, what was that next one?
NST.
So another gold stock, and yeah, here's the risk with buying gold after a parabolic move, is that it comes back quickly. So if I had Northern Star, I'd be happy holding it. Wide trailing stop, well below the 100-day moving average. Try and see this off. So this is the hot money. The hot money's come in and panicked on the upside, fear of missing out, pushed it higher, and now it's reversing. It's the hot money quickly leaves the scene, and this may be what's happening now. So I'm not buying it. I'm holding it if I've got it, and see how it plays out. Looks like Evolution is holding up a bit better. Evolution's holding up better at this point, but yeah, other than special situations like maybe MAU that we looked at earlier, where there could be an explorer type situation, yeah, I'd be careful buying gold stocks just at the moment.
All right, next one's Telstra, TLS.
Yeah, it continues to hold up really well. We looked at this a week or two ago, and it's like you wouldn't know there's been volatility in the broader market. I'd be very happy holding this stock. Um, it looks like it's to me. It looks like it's going higher. Trends up. Do I want to buy it? Like we spoke about this a couple of weeks ago, and I think I might have thought it's possible buy. It is getting a little bit further away from the 50-day moving average. Yeah, Yeah, I'd probably, I don't know. I'm not an enthusiastic buyer at current levels. I prefer buying stocks when they're pulling back to the averages and rallying off them, rather than after they've rallied for a bit. But I'd be very happy holding it. It's Telstra is looking good.
Good one to hold. BOE.
We kind of just looked at that with uranium generally, and like see where this goes. It's back above the moving averages. Uh, Look, if somebody wanted to try and pick the turning point in uranium, this is probably a decent stock to do it in, because we've got a clear level to watch from the 22nd of April. So, say it was bought at current levels, it's a 25% stop. 25% stop. See if it goes. Like, could this be a basing type of period? Like you could say, like, is this this could be like a wedging type type structure where the market like forms within this declining range, but it's a contracting range, so it's losing momentum each pass lower, and they can't sustain the momentum. Then it starts to work to the upside, and then it breaks to the top side, and then starts to rally. So if somebody wanted to sort of like try and play the turn, and the turn may not be happening at the moment because we saw with the uranium price it is still in the downtrend. But if we wanted to play the turn, maybe buy BOE here, stop loss below the 22 April low. I think that there's certainly merit in that.
Okay. AVR.
No, it's a downtrend. It's got a snapback rally to the moving averages, but there's been too much going against this stock for too long. It's for me, it's just an avoid, and I won't even say if I was holding it, because I wouldn't be holding it. Maybe this is a rally that turns it around, but we've seen these rallies back to the moving averages before. Like we could have looked at it here and gone, oh look, it's a strong rally back to the averages. Maybe this is it. Maybe this is it. Maybe it's not. I think we're playing against the odds when we're trying to trade stocks below the averages. I think we just got to leave them alone. Focus on the ones which are above the averages. If we like a stock and it happens to be below the averages, keep watching it by all means. But then just wait for the environment to move more towards your favour than try to play from the back line when the line keeps slipping back. I'd just leave it for now.
Okay. AVH.
So for me, it's too early. Is there a basing period going on? Yeah, look, it's possible. Possible you could say there's going to be support coming through around $2.50. So look, if someone was holding this stock, I think a break below these previous lows, or down to around 220, would probably be enough to say, look, I think it's probably time just to exit. But if these lows hold, well, by all means, see if it can regain some momentum. I wouldn't be hurrying to buy it at the moment, but I think the good point is on the downside, we've got a clear level to watch. So it could be a hold, but we know where to cut and run.
Okay, Rob wants us to look at 360.
Well, this had been a motion trader stock until recently. Yeah, so motion trader got this nice rally in the stock, and then it triggered the trailing stop during the big sell off we had recently, and now it's rebounded. And this is one of those things with trailing stops. Just because the trailing stop triggers doesn't guarantee the stock's going to continue to unwind. Sometimes they snap back, and then people say, "Oh, I shouldn't have used the trailing stop. I should have just held." It's all great when they snap back, but what I say to people, it's not the ones that snap back that cause you the issue. It's the ones that keep unraveling. That's why I think we need an exit strategy. Now with this one here, with it snapping back, if I'd held it through this strong period and I'd sold it recently, and now I see it snap back and it's above my exit point, it's like, well, these things are going to happen. I'd be looking elsewhere. I wouldn't be looking to quickly jump back into this stock, simply because it doesn't meet my buy criteria at this point. It's just getting back above the averages, but the 50-day average is still below the 100-day average. So the 50 days got to swing back around and take the lead, as it did like back in 2024. So it's going to take a while for this to meet my buy criteria. So I'd be inclined to leave this one to the side at the moment, and just let the price action settle down, and approach it later on when we've got some more price information. For me, it's a leave alone. If I happen to be holding it still and I didn't use a trailing stop before, well, great, I can keep holding it. But I don't think it's a buy for me at this point.
Okay. Hub.
Same situation as 360. This was a motion trader stock. It had done really well. It was up several 100%. The wide trailing stop saw off all these pullbacks to the moving averages, but this was too big, and it was a cut the position. Now it's come roaring back. Is it going to new highs? I don't know. It could, but it doesn't meet my entry criteria at the moment. That's going to take a little bit more time to do. I'd just leave this one to the side. If I was holding it and I'd seen off that sell off and I'm still holding it, well, great, I'd keep holding it. But I wouldn't be a buyer at this point.
Yep. All right. Next one's SOL. We'll have to have a look. You found Sol Patterson.
Well, this is breaking higher. It's you can see this. You see this range. It's just broken out from. So this is a stock I'd consider buying. It's more of an ETF, more of a managed fund type situation than an actual standalone company, as I understand it. But yeah, it's a breakout, so it's one to consider an entry for. I'd be happy holding it, and I'd consider buying it. Mm-hmm. And I think risk is easily managed because we've got the what's clearly managed because we've got this breakout point here. So stock could be set just back probably around about the 100-day moving average. So it's nicely back within inside the range. So if it has a pullback to the top of the range, maybe it consolidates and then maybe it rallies again. But if it fails, comes back mid-range, we'll just close it out. So it's probably relatively low risk to have a go at this one at current levels.
Next question's from one of our international viewers here, John. Hi, John. Sorry, Giovanni. Sorry. Oh, John. He's got Giovanni or John. He wants to hear. He's in the middle. They're in the middle of a national election. Funnily enough, we're a week away from our national election as well, there, John. But he wants to hear thoughts on the TSE. Now, is that the Canadian Stock Exchange?
Yep, that would be it. And I've got it up here in my list of markets. TSX.
Is it the TSX? TSX.
No, that would be.
Or is it a stock,
That's
John?
Tokyo. That's a Tokyo exchange. I've got it here somewhere. Look, I just type it in.
There is a stock with TSE there, so I don't know if it's that one there. Could
What's
be
the
that
Canadian Toronto Stock Exchange? It's a TSX. I think it's TSX. That's it. Toronto Stock Exchange. Well, it's not dissimilar to the ASX, and it's big resource base, so there's similarities, and there's also been a strong banking sector, so there's a lot of similarities with the ASX. It's moved back above the moving averages. It's looking very much V-shaped. So a lot of the things we've said about the ASX and the S&P 500 apply here. This is looking more and more like a panic-driven sell-off than a bearish turn. So with this, I'm not sure the election's a major factor. It's more like elections pass, and there's always uncertainty around elections, and then they pass, and the market tends to just then move on rather than move one way or the other depending on the election. I'd be cautious. I'd be approaching this as a cautious re-entry. To like, if I had a portfolio in this market, I would have done the same thing as in the ASX. I would have been exiting stocks as the market was weakening, wide trailing stops, and then but now as the market's coming back, getting back above the moving averages, I don't think it's a point to say, okay, right, this is ready to go. We're off and away again. I think there's vulnerability still within markets generally, but I'd be moving cautiously towards the buy side. That's how I'd be approaching this. I wouldn't be saying, okay, look, I've run to the hills and I'm staying there because volatility has picked up. Because what we know from the past is we get these bouts of volatility. Everyone gets scared. People sell their portfolios, and then the markets recover and go on the new highs. And there've been people left on the wayside because they didn't come back in. So I think we want to approach this from reinvesting, but also not just getting too carried away in case this is more prolonged than it does. We get a lengthy sideways period and there's more chop. It could play out many different ways, but I think we want to approach the TSX like the ASX, like the SPX or the SP 500, in that it's a cautious re-entry, and let's see where this goes.
All right, next one's Telix. Telix, Telix.
Yeah, it's snapped back nicely. If I'd survived the sell-off, I'd be happy holding it. Wonder whether it survived the sell-off. So just putting on it's potentially seen off the sell-off. So if the wide trailing stop as it looks has seen off the selling, I'd be happy to continue to keep this in my portfolio. It's rallied back above the moving averages, pull back to the averages. Looks like it's rallying off the averages again. So then this could be called like a deep zigzag correction. And maybe there's new highs coming. I'd be happy holding it. Am I a buyer? Oh, look, if it breaks above the high from last week, maybe it's a buy. It's probably a buy if it can break above last Wednesday's high. That would show the momentum's coming back in. It's being pushed higher. Buying coming in. Could probably go with it.
Fantastic. XRO.
But this one did get stopped out. It was a motion trader stock which was stopped out. It doesn't meet my entry criteria, so I'm not a buyer. Although it does look like maybe this is one of those ones which will recover. For me though, I want to wait till it meets my buy criteria. So I'm systematic. I'm rules based. I'm looking for stocks which are above rising moving averages, hitting a 70-day high. So from that criteria, it just doesn't meet it. So I'm not just trying to punt stocks which I think could turn. And there's nothing wrong with trying to pick turns in stocks if you can manage your risk, but it's just not what I'm doing. So I'd be inclined to leave this one alone. I think you can probably say there's some resistance through here around 164.40 ish thereabout. So break above here, break to maybe up through to 167 odd, above the moving average, above the resistance. It may be saying this stock's going to continue to improve. But at the moment, I'd just be I'm probably more of a watcher rather than ready to buy at the moment.
Okay. CCP from Eloise.
No, we're just clearly below these moving averages. We're getting a rebound, but the trend's very much down still. This is a stock I would have exited earlier, and it's not a stock I want to try and pick the low in. If I want to try and pick a low, something like BOE, which we looked at, or getting a turn in XRO, which was the previous stock, but a stock like this, which is just clearly declining below the moving averages, I think it's just best left alone.
Yeah. Last one here is Zip, please, Chase.
Same situation here. It's just like look at this rally back to the moving averages, and then it fell away. So we can look at this and think what would we been saying at the time? Like XRO, it's rallied back to its averages, but you heard me say I'm not an enthusiastic buy because things are more likely to go wrong below the moving averages. And of course, stocks will bottom, and invariably they'll be below the moving averages. If it's been in a bearish phase, it will bottom below the moving averages. But trying to pick that correct entry point, it's a really difficult thing to do because you could have said, look, this has been a strong stock. This is just a bit of panic selling. Look how quickly it snapped back, and then look how quickly the selling came in and drove it down. So this is the great risk below the averages. So this rally back to the averages, well, maybe this is it. Maybe this is the turn that takes this higher, or it could be another case of sell the rally. So I work on the basis that below the moving averages, the greater risk is sell the rally. So I don't want to play. I'd rather play buy the dip when we're above rising moving averages. And look, sometimes you can pinpoint the low and you do really well. But I think if you try to do that regularly, you're more often than not going to be disappointed. I'd rather play where the odds are more in my favour, and that's when I'm going with the general tide. I'm not trying to pick the turn in the tide. I think that's a hard thing to consistently do, and it's when you're wrong where it can you can really pay dearly for it. So I'd leave this one alone.
All right, fantastic. Some great examples there of both possible opportunities as well as ones that we would leave alone, Jace. So fantastic. Thanks, viewers, for your tickers, and thanks for your questions. It's been another great week. I think we're at this point now in the markets where we the next week or two, especially with elections around the world and going on, it's not that it has major impact, but it's we're either going to see it come down again or go to that next level up, right? So it should be interesting over the next couple of weeks. Please do come and see us again next week. But until then, don't forget, once again, do like and subscribe our show, like and subscribe on our show. Hit the notification button if you forget about the 12 o'clock Australian Australian Eastern Standard Time, the time that we have. Go and visit Jason over at motiontrader.com.au so you can check out his service. And if you've got any questions around Selfwealth and our platform, obviously you can direct them to the support at selfwealth.com.au email address, and you can attention to me if you'd like. Other than that, don't forget this show is also general advice only. So make sure you do your own research, do your own due diligence, and stay safe out there. That's what we try and teach as best as we can, right? So please do review the videos or the teachings that we do, because I think it's some of the best out there in terms of protecting your capital, managing your capital as well, and not just looking for opportunities, right? So and not just picking signals, right? So fantastic, Jace. Thanks again for your time, mate. Very much appreciated.
Hey, thanks, Rog. Thanks, viewers, for coming and joining us. It's I love going through all those stocks and really interesting examples and things to talk about there. Hopefully it's been useful and interesting for you. And yeah, look forward to next week.
Certainly has, and we look forward to next week as well. Have a good week, everybody. Actually, now that I think about it, we're not going to have next week, Jace. I've just remembered I will not be here. I'll actually be in Sydney, but I won't be available. All right. So I'm putting a notice out to the viewers that we won't do it next week. I won't be available next week. So it'll be the week after. Sorry. So we're going to have to see the markets play out. I've just remembered. We're going to have to see the markets play out. So we will be back, obviously, on May 6th next week, May the 13th. All right. So May the 13th. All right, everyone. Thank you very much. And sorry for that hiccup there. And we will see you in a couple of weeks' time. Take care, everyone. Bye-bye.